Welcome back to the Global Ledger. I'm Justin. I think it's time to clear the air a little bit. If you've been online lately, you've heard some version of this, that the dollar is crashing, monetization is inevitable, America will have to print to fund the AI race, short-term borrowing is basically injecting cash into the system, and tariffs are the final nail in the coffin. It sounds coherent, and it sounds like a single story, but it isn't. It's three different stories stitched together using the same dramatic vocabulary. Today, we're going to separate the mechanisms, and once we do, you'll see what's real, what's exaggerated, and what to actually watch. Let's get into it. So, for everybody that's been here before, this is a Mythbusting series, and we take we like to take trending narratives, trending stories, and just unpack them and find the truth in them as it relates to the system. And today's myth is as follows. The dollar is crashing because the U.S. has too much debt. Tariffs are shrinking trade, and the only way to fund everything is to push borrowing to the short end, which is basically printing. Okay, so we're going to break that down carefully. Okay, here's another way to put the myth. Okay, here's kind of it in one sentence as well. In 2026, 2027, the dollar will fall hard because the U.S. is forced to flood the system with short-term debt and rate cuts, while the global world reduces demand for dollars and America monetizes its obligations. That sentence bundles together three things. Number one, FX direction, which has to do with the dollar's exchange rate. Okay. Number two, Treasury financing strategy. Okay, bills versus bonds kind of thing. And number three, central bank balance sheet behavior, monetization, basically. These are related, okay, but they are not the same thing. So we're going to address this in three parts. Part one, what it even means for the dollar to be down. Part two, why short-term borrowing is not injecting cash. Okay. Part three, what monetization actually is and how to tell if it's happening. And at the end, I'll give you a clean dashboard, okay, 5 things to watch that are more useful than the gloom and doom that seems to spread fairly quick. So part one, the dollar is down. Doesn't mean the dollar is breaking. Okay, when someone says the dollar is down, the first question is down against what? Okay, most people are referencing a broad dollar index, something like DXY type concept. Okay, where the dollar is measured against a basket of other currencies. That's not a collapse indicator. That's a relative price. And a relative price can move for completely normal reasons. Okay, the first misunderstanding, FX is not a report card for morality. It's not a debt rating. It's not a referendum on the empire. FX is often interest rate differentials, growth differentials, hedging flows, risk on versus risk off cycles, and sometimes geopolitical risk premium. So yes, if the dollar is weaker, it can reflect concerns, okay? But it can also reflect the market anticipating rate cuts faster in the US than elsewhere. Capital moving into non-dollar risk assets, foreign investors hedging US exposure more aggressively, okay? Or simply a shift from panic into risk appetite. That is not cracking. That is normal FX market behavior in general. Okay, so that's the first misunderstanding. The second misunderstanding in part one. People confuse reserve currency with exchange rate strength. The dollar can weaken for long stretches while still being the dominant currency to global funding or global collateral, commodities pricing, and global safety demand during stress. Reserve currency status is not just who's up this year. It's about the depth of markets, rule of law credibility, ability to absorb global savings, and the dollar funding ecosystem that sits underneath trade and finance. So if you want to claim the dollar's breaking, you need to show more than FX move. You need to show that the global dollar system is losing its utility in the places where it actually matters, like funding, collateral, payment networks, and safe asset demand. So hold that thought, because we're going to the part that gets abused the most. The claim that issuing more short-term debt is injecting cash. Part two, Treasury bills are not money printing. Here's the viral claim with this. If the U.S. shifts borrowing to 1 month, 3 month, and one year debt, it's basically injecting cash into the entire system. That sounds plausible, but it's confusing financing with money creation. Here's kind of the basic truth, When the Treasury borrows, it is swapping one asset for another in the private sector. Investors give dollars to Treasury. Treasury gives investors a Treasury security. That is not net new money. That's a portfolio swap. It changes the composition of private sector assets, fewer cash balances, more Treasury bills. So why does bill issuance feel like liquidity? Because bills behave like near money. They are short duration, they are highly liquid, they are widely accepted in collateral chains, and they can be financed very easy. So when Treasury issues more bills, it can feel like the system has more cash like paper. But cash-like is not cash. And this is the key difference. Money creation is when the banking system or the central bank expands net balances, reserves, deposits, without an offsetting removal. Debt issuance is an asset swap. Cash leaves the buyer, bills enter the buyer. Now, so here's where it kind of gets interesting. And this is the part most commentary misses, I think. Where does the buyer get the money to buy the bills? That's the plumbing. If bills are being absorbed mostly by money market funds, foreign official holders, banks, or indirectly by the Fed, the system level effect is different. And the biggest tell in modern plumbing is this, the RRP / reserves channel, this is like the silent channel, in many regimes, money market funds are sitting in Fed facilities or cash-like instruments. So when the Treasury issues bills at attractive yields, money market funds rotate out of one cash-like parking spot into Treasury bills. That can change reserve balances in the banking system. That can change funding spreads or collateral availability. But again, that's not printing money. That's money market plumbing responding to relative yields. So here's the real point with this. A Treasury shift to short-end issuance is a duration management decision, a funding cost decision, and a collateral distribution decision. It can affect financial conditions, but calling it injecting cash is kind of sloppy. It's like saying, if I refinance my mortgage from a 30-year to a 5-year ARM, I just created money. No. you change the maturity profile in your interest sensitivity. Okay, you didn't print money. Part 3. What monetization really means. We get here into the heavy word, which I think is monetization, because it gets used constantly and usually incorrectly. Here is what monetization actually means in operational terms. The central bank is absorbing government debt in a way that turns it into base money, reserves, on a sustained basis. Okay, so just in plain English here, Treasury issues debt, central bank buys it, reserves rise and stay high, the central bank becomes the marginal buyer of duration. That is different from rate cuts, routine market operations, short-term lending facilities, or temporary liquidity swaps. Those can be supportive, but they are not automatically monetization. If you want to claim monetization, you need to identify, number 1, who is absorbing net supply, and number 2, whether the central bank balance sheet is structurally expanding to do it. Because here's the thing. Even in a world of huge deficits, the U.S. can fund itself through domestic private savings, foreign private savings, money market funds, pension allocations, collateralized funding chains, and regulatory-driven demand. Okay, a lot. And this starts to get in kind of the power of this, but none of that requires immediate monetization. But the U.S. has to fund AI and rebuild supply chains. This is another part of the myth, okay? The claim is basically we have too many national projects, so we must monetize. No. What that actually means is we may run fiscal deficits while attempting industrial policy. Okay, deficits can pressure yields, deficits can pressure term premium, deficits can alter FX expectations, but deficits are not automatically monetization. Monetization is a central bank action, not a national mood, if you will. So why does this feel like it's happening? Because people watch two things move together: rising debt issuance and easier central bank policy. And they assume the second exists purely to fund the first. Sometimes that's partially true. Often it's not. Central banks are typically responding to inflation path, labor market conditions, credit stress, and financial stability risks. And sometimes, yes, government financing conditions matter. But if you want to make the argument credible, you need to point to the balance sheet mechanics, not just they cut rates. Let's move on to the tariff confusion. Trade flows do not equal dollar demand in one direction. Here is the tariff claim. Okay, quote, if we put tariffs on the world, trade falls, and that's ominous for the dollar, unquote. Okay, so this is where people go straight into narrative and skip accounting, I think. Tariffs can reduce imports. If imports fall, that can reduce the number of dollars leaving the U.S. in payment for goods. That can actually reduce external dollar outflow. At the same time, tariffs can increase domestic prices for certain goods, pressure growth, invite retaliation, of course, and change capital flow expectations. So what happens to the dollar? Well, it depends on rate differentials, growth relative to the rest of the world, risk sentiment, and also how investors reposition. There's no automatic tariffs equal dollar collapse function here, okay? If anything, sometimes the dollar strengthens during trade conflict because global risk rises. People seek liquidity. and the dollar still sits at the center of the liquidity map. Again, you don't have to love it, but you just have to model it. So if it's not the dollar cracking, what is the real story underneath this kind of commentary? Here's what I think. Number one, we're in a regime where duration is extremely, it's expensive. Long-term yields can remain elevated even when short rates fall. That can happen because supply is heavy, or term premiums rise, or inflation risk is persistent, and investors demand compensation for duration. Okay. Number two, the Treasury is managing financing costs and market function. Shifting issuance towards bills can reduce near-term funding strain and improve auction outcomes. It's not printing, it's maturity management under constraints. So, number three, I think FX is responding to relative policy paths and also portfolio flows. The dollar can fall without the system breaking. A weaker dollar can mean the U.S. is easing faster, or risk is on, or hedging demand is rising. The structural question isn't, is the dollar down? The structural question is the world building functional alternatives to dollar funding and dollar collateral at scale? That's slower, messier, and more institutional than a headline. So I'm going to go straight to the global ledger dashboard, if you will, and basically give you 5 things to watch. Okay, if you want to replace, the doom content with signal, I think here are 5 indicators that actually matter. Number 1, funding spreads. If dollar funding is genuinely stressed, you'll see it in spreads, not just in the FX market. Okay, that's number 1. Number 2, auction quality. Look at bid to cover, tails, and dealer takedowns. This tells you who is absorbing supply and at what price. That's number 2. Number 3, the Fed balance sheet trend. Okay, not the press conference. Okay, not any of the rhetoric either that tends to follow with the media stuff, but the actual balance sheet direction over quarters. That's number 3. Number 4, I would look for cross-currency basis and hedging cost. Okay, this is kind of the hidden tax on global dollar demand. And number 5, collateral behavior. Look at repo conditions, specials, and stress in the collateral chain. Okay, because the world doesn't run on narratives; it runs on funding. And don't worry, as we continue on into the channel, we will be discussing a lot of these things that we're hearing or we're talking about in extreme detail. So here's the bottom line. Okay, the dollar can weaken, the Treasury can shift to bills, rates can fall, and none of that automatically equals monetization or currency collapse or an imminent end of the global dollar system. If someone wants to argue the dollar is cracking, they need to show breakage in funding networks, breakage in collateral trusts, and a credible alternative system as well, at scale too. So until then, most of what you're watching is a regime shift in rates and portfolio allocation, not a financial apocalypse. If you want, in the next Mythbusting episode, we can go a layer deep. What it would actually look like if the dollar system were breaking. So drop a comment with one word. FX. Let's use that one. If you want this series to stay on currencies or plumbing. If you want the next episode to go deeper into funding and collateral as well. And if this episode helped you, maybe replace some of the noise with mechanisms to the system and maybe eased your mind a little bit, I would definitely love to have you as a subscriber. Because the best edge in markets, I don't think is prediction. I think it's clarity. So once again, I'm Justin, and thank you for being here.